Hello, and thank you for joining us. With me today is Simon Steele, Senior Portfolio Manager and Head of the Fiera Atlas Global Company Strategy and Team, boasting over 30 years of direct global equity investing experience. So let's jump right in. Simon, welcome. So what is your strategy aiming to achieve?
We aim to achieve double-digit through-cycle returns over the long term. Our research suggests that through-cycle strategy returns of approximately 12% are competitive versus both our peer group and the market. Therefore, we only invest in companies where we see a clear opportunity for double-digit annualized returns over a minimum 5-year period, led by fundamentals, the compounding of cash flows, and not changes in valuation. We also value stability and seek to invest in companies where the volatility of their cash flows are relatively low and less prone to changes in the economic backdrop. In our opinion, this offers us more stable returns and some protection when the economic and the earnings cycle is in retreat.
What kind of investor are you?
We are long-term, bottom-up, fundamental investors. We hold around 30 stocks with an average since inception turnover of less than 20% per annum, suggesting an average holding period in excess of 5 years. We are categorized as quality growth investors, although we believe the definition to be very broad, disguising many different approaches and outcomes. Our view of quality is defined by a company's ability to generate high returns on capital, persistently and consistently for many years, and comfortably in excess of the cost of capital. This is the first stage of a company creating value and stage one of being exceptional. The definition of growth itself is self-evident. What is less well understood, though, is that growth in and of itself does not create value. Indeed, growth at below the cost of capital destroys value. Companies can only create additional value when both growth and high levels of profitability coexist simultaneously and persistently. We call these exceptional companies as they're reasonably rare. We will never buy growth without the backing of sustainable high profitability, nor will we ever purchase high profitability without the backing of a supportive long-term growth backdrop.
What's the investment philosophy that underpins your approach?
We believe that over the long run, fundamentals rather than valuations explain the bulk of long-term share price moves. Our research suggests that over 10 years, upwards of 85% of total shareholder returns are explained by movements in fundamentals, in other words, earnings and dividends, not changes in valuation. This is in contrast to shorter term time horizons, where changes in valuation explain a greater proportion of share price moves, principally because fundamentals, earnings and dividends, have not had a chance to compound over shorter time frames. Our belief is that markets are preoccupied with the short term, and this yields an exploitable edge to patient investors like ourselves who are prepared to assess value over a longer time horizon than the marginal buyer and in excess of average holding periods. In our case, 5 years and beyond. In our view, the combination of patience and above average long-term compounding of fundamentals are thus the most important factors in generating repeatable long-term alpha and are thus the bedrock of our philosophy. To best express our philosophy, we seek to invest in exceptional companies that are aligned with our dual financial objectives.
Fantastic. Thank you so much for joining us.